Today's episode is brought to you by AlphaSense, the market intelligence platform I rely on for faster, deeper insight. If you've used platforms like Tedious, you'll feel right at home. But AlphaSense takes it further. With over 150,000 expert call transcripts and 450 million plus premium documents, it's become my go-to resource for qualitative and competitive research. And now, with generative AI tools like GenSearch and GenGrid, AlphaSense makes it easier than ever to accelerate your workflow. GenSearch lets you ask natural language questions, like what's driving margin pressure in semis, and instantly surfaces answers pulled from expert calls, earnings transcripts, filings, and more. GenGrid takes it a step further, automating repeatable workflows by applying multiple prompts across dozens of documents at once. It delivers clean, table format answers like sales trends, macro commentary, or pricing signals, all with clickable citations so you can trace insights directly to the source. Whether you're digging into a company, comparing peers, or parsing 10Ks at scale, AlphaSense gives you a speed and depth advantage. Try it for free today at alphasense.com/YAVP and experience the future of research. That's alphasense.com/YAVP. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, we know a lot of you could rate, subscribe, review wherever you're watching or listening to it. With me today, I am happy to have on, I think it's for this, is it the second or the third time, Mordechai? Do you know? Third? I know we did SMC. Okay, third time. My friend Mordechai Yavneh. Mordechai, how's it going?
Good, thank God. Thank you for having me.
I should have mentioned Mordechai is the head of Focus Capital Advisers and also kind of has the shingle out for the outsourced consulting analyst role as well. So people can reach out to Mordechai if they're interested in learning more about either. Mordechai, where can people reach you?
You can look me up on focuscapitalmanagement.com focuscapitaladvisors.com with an E, advisors with an E. Is our website. You can see all about the way we approach investing and approach analysis. My email's there on the contact page. Feel free to reach out to me if you're interested in the fund or if you're interested in outsourced idea generation or outsourcing analysis of specific deals or ideas. It's something we've been doing recently as well.
Perfect. And speaking of diving deep into ideas, I think we have a fascinating one today. But before we get into it, I'll just start this podcast the way I do every podcast. Disclaimer, remind everyone, nothing on this podcast is investing advice. Please consult a financial advisor, do your own work. That is always true. But, extra disclaimer, this is a international Canadian traded company and their assets are often the Gulf of Thailand. So Gulf of Thailand and some assets in Turkey. So please keep in mind that, boom, heightened risk. So keep all of that in mind. Consult that financial advisor. This is an investment advice. Mordechai, company we're going to talk about today is Valeura Energy. The ticker is VLE, trades up in Canada, if I'm remembering correctly. And I'd love to just start by tossing over to you. What is Valeura Energy and why are they so interesting?
Okay, so just for the intro, the ways people often, approach investment ideas, they'll say, do you like, asset-light growth companies with turnaround situation? Then this is for you. No. So what I'm going to say is, if you like money, this is the stock for you because it is so tremendously undervalued for what it is. It's just off the charts. What is Valeura Energy? Valeura Energy is an oil company. It has basically all its producing assets are in the Gulf of Thailand. It is extremely profitable. It has lots of cash, no debt, and it's set to make basically its enterprise value within over the next 2 to 3 years just from gushing cash, even at slightly lower oil prices than it is now. Obviously, I don't know whether the oil price will go up or down. If it goes down, they'll make less money. If it goes up, they'll make more money, but they can be profitable even in that sharply lower prices, less profitable. Much higher prices, they'll be through the roof profitable. But as it's set now, they're set to make the entire enterprise value, market cap minus cash, within 2 years, and they are just tremendously undervalued. The main reason, I think, for the undervaluation is that they're relatively new to the market in the sense that they used to be a company that was focused on some Turkish gas assets. They sold that off in 2020, and they were just pretty much a one asset that was not was not being developed, that was on hold, and a bucket of cash that was looking for an acquisition. And to their credit, and they've been very masterful capital allocators, they didn't let that cash burn a hole in their pocket and like snap up a deal, the first deal they could find, but they were patient. It took them a few years until they finally closed on two transformational deals. And usually the history is not so important, but I think in this case, it is edifying and educational to understand how they got to where they are now. They made two deals in 2020, in 2022, and totally transformed the company from basically a bucket of cash of $40 million to what it is now, second largest, the largest independent producer, second largest total in the Gulf of Thailand, with instead of $40 million cash, it now has $260 million cash as of December 31st, no debt, and a highly profitable company. How'd they get there from $40 million? It sounds like a great parlay. So what they did was like this. There were two acquisitions. The first acquisition was a very good acquisition. I haven't seen too many acquisitions as good as this acquisition. Was basically they bought out the bankrupt Chris Energy had gone bankrupt during the massive oil drops. They were highly indebted. They had a profitable field, but with the debt, they couldn't service that debt. They went bankrupt. And they basically bought out the Wassana field from Chris Energy's bankruptcy. They paid a relatively low price. They paid about $3 million for the oil field, $9 million for equipment that came with it. So let's just round it all together. They paid $12.3 million plus another $7 million of contingent payment. Without getting into details, about $2 of that million is really relevant. The other $5 million, they kind of passed on when they passed on part of the field to someone else. So basically, they paid $14.5 million, is basically what it boils down to. $14.5 million for the Wassana field, which was already a producing field, was just on hold. It was on hold back when prices had dropped to like $30 a barrel. Prices were back up to close to 100. At the time, they were, more like in the 80s, 90s when they were negotiating this deal. It was ready to restart at about 3,000 barrels a day, oil. There was potential to rise to maybe 4,500, 5,000 barrels a day. OPEX was relatively low, $36 a barrel, so profitable at 80, 70, 60. It's a profitable field. So that's basically what they bought. They bought that, and they bought a 43% portion in the Rasukan field, which they sold off afterwards. So basically, they bought the Wassana field. It sounds a little complicated. Basically, they bought the Wassana field for $14.5 million. That Wassana field cash flows about $36 million annually, after royalties, after OPEX, after tax.
Let's pause here, because the next acquisition, we're like saving the big boys to the end. The next acquisition, I've seen your slides, I've followed your work, is what you consider the greatest acquisition of all time, and it might be. But I just want to pause here, right? You've got, they buy for $10 million ish. They buy a oil field in the Gulf of Thailand. So I have two questions for you. Most of my listeners are domestic. The Gulf of Thailand, you say $35 kind of break evens, deep wells, 3,000 barrels. Would I be right for my domestic listeners say, hey, offshore in the Gulf of Thailand, obviously its own political risk, but kind of resembles offshore in the Gulf of America or Mexico or whatever we're calling it these days?
There are major differences. First of all, you just to talk about the political risk you mentioned, it's not nearly as political risk as you make it out to be. Thailand has had an oil industry for decades and decades. They have not had any history whatsoever. They have a thriving workforce in the oil and gas industry. It's considered a major contributor to the economy. They support the oil and gas industry. And what I really want to underline is they've never changed deal terms ever. In other words, they've had many different tax regimes for the oil and gas industry. There's a Thai 1 fiscal terms, a Thai 2 fiscal terms, a Thai 3 fiscal terms, a Thai 4, et cetera. Yeah. But they've always changed it prospectively. Any concession that was already given stays with the terms it was given at the time. They've never changed the deal retroactively, and this has been decades and decades. I don't think the political risk for the oil and gas industry in Thailand is that heightened.
I wasn't saying it as there is political. I just meant like there is political risk anywhere where you have the government. And obviously, Thailand versus America is different.
It could be other things in Thailand I think would have a heightened political risk. Thailand is not exactly known for being the easiest people to deal with. The government is not known for being democratic or non-corrupt. It's actually pretty not democratic and pretty, yes, corrupt. And I don't know how many coups they've had since going independent. 8, 9. I'm not sure what number they're up to now. So Thailand is not the place to deal with. But the oil and gas industry has been pretty insulated from the political upheavals that Thailand has been having.
Just the economics of offshore and Gulf of Thailand. Would people be right to think
Thailand is not deep water? It's relatively shallow.
Okay.
And pretty simple throughout. That 1,500 feet at the deepest. More or less. So it's not really necessarily the same as many offshore plays, which are far deeper and have more complicated geology. There is, however, something unique to the geology of the Gulf of Thailand, which I want to get into later, which is that although the reserves appear to, on the surface, be relatively limited, and your life of field only extends out 2, 3, 4 years, what actually happens is that reserve keeps on being refilled as you go through as you drill wells and infill wells and more drilling. You tend to replace all the reserves, and your field that officially started with a 3-year life ends up lasting 30 years. Yeah, and that's something I have to get into because I think in this particular company, a lot of investors look at the company and they see it's a very short RLI, life index of how long the fields are going to last. And then they're going to have to pay for the abandonment costs and the decommissioning, and there's no far future here. And that's really not the way it works in the Gulf of Thailand. It doesn't have large reserves that you tap into. It has kind of multiple stacked reservoirs. So the reservoir you hit is the one that gets officially counted as reserves, and the next one that you didn't get to yet isn't counted as reserves because you haven't actually proven beyond doubt that it's there. But about 95% success on every well throughout the Gulf of Thailand. I'm not referring to Valeura in particular, but in general, you dig next well, 95% of the time, get more oil on each well. So you dig 10 wells, 9.5 of them will hit more oil. And you produce 2 million barrels from your field. During the production, 2 million barrels, you discover another 2 million barrels. So you produce what you have and just replace it, and you keep on going. And so it's not really the short life that it looks like it has. Is quite it's quite. So
let me ask my second question. So none of these are like the characteristics of Gulf of Thailand wells refilling are not unknown. The economics of these wells are not unknown. I think the first thing, and this will be a big question for the second one as well, but the first thing that jumps out to me is, hey, they bought this well for $10 million-ish, 10, 15, whatever you want to call it. Mordechai laid out the math. Oil prices were 70. Actually, when they bought it, oil prices were approaching 100. Right. The cost per barrel is 35.
Annually was what they were making. Now with lower oil prices of close to 70, it's only cash flowing $12 million annually.
Okay. So oil prices it's cash flowing between, my math was like over $20 million. It's 15 million, whatever. They buy this thing with great repleting reserves for 1 times free cash flow. And I think the question that immediately jumps to mind is why? Who is on the other end? Why are they selling this? Why wasn't there a competitive process? Like,
that one was buying out from bankruptcy. Buying from bankruptcy often gets you good deals. That's not exactly surprising to anybody. The creditors have control of the company. They're looking to sell off the assets. They're not looking to operate. There aren't that many players that, the majors are not dealing with such a tiny oil field of 3,000 barrels a day. No interest for them. There are not that many regional players that are in place to make bids. There are a couple of regional players that one could say are similar in size and ambition to Valeura, but a lot of them themselves are were and are indebted, facing operation troubles of their own, and otherwise not really available to make a bid on all the assets available. There was a bidding process. I believe there were other bidders, and they won the process.
But just the other bidders, right? Like you've got to process. These guys buy this for one times cash flow, right? Like it seems like the other bidders, like, if you and I were sitting there, be like, oh man, our bid of half a year's worth of cash flow didn't get accepted. Like why?
It wasn't actually the field wasn't producing at the time. The field was on hold. They had to spend a year or so to fix up the equipment and get it running. And then immediately after they got it running, they had to halt. There was an issue, and then another issue 6 months later where they had to halt. First because one of the ships that was brought to the area to work on managed to hit one of the legs of the platform, so they had to deal with that. And then there was a crack found in one of the legs of the platform. And even now, they are admitting that the platform is nearing end of life. They're going to have to replace it, or more ambitiously, start a whole new larger platform, which is what they're considering. We'll talk about that later, to expand the whole development entirely. But it's not exactly they were buying something that was cash flowing at the time they bought it. A year and a half later, with more money put in, is when it started flowing. So not exactly. And it's bankruptcy. I don't think it's so surprising they got a good deal from bankruptcy. I think you'll find a lot of situations like that.
I don't know. Why don't we go to the second acquisition?
Okay,
so the first acquisition is like
that brought them to Thailand.
Yeah.
Now they are a player in Thailand. They have an asset in Thailand, pretty small, and then they came to what I would call the greatest acquisition of all time, where they bought out Mubadala Energy's Gulf of Thailand assets. Mubadala Energy is an arm of one of Abu Dhabi's sovereign wealth funds, and Mubadala Energy decided to exit the Gulf of Thailand oil industry, and they put it on the block, and there was a bidding process. They bought what was basically about 20,000 barrels a day of flowing oil. This oil was on and working. And when they announced the deal in December 2022, it closed in, they announced the deal in December, and they closed the deal in March. But like is often so, when they announced the deal, it was the effective date is not the date of closing. A lot of times in the oil industry, the effective date is earlier. So in this case, the effective date, the time that all the economics accrued to Valeura was before they signed the deal, was September 1st. So they closed in March, but the previous 7 months of production from September 1st to the end of March all accrued to Valeura, was kept as a lockbox in the company and stayed with the company and went to Valeura's credit. So they're getting this 20,000 barrel a day enterprise, not just the fields. They're buying, they bought the field, all the employees, everybody carried over. The only person who didn't come over was the Thailand country manager, which was, Mubadala Energy's person. That stayed with Mubadala. But the entire enterprise, all the employees, all the staff, all the technical and engineering and layers of management went over to Valeura, lock, stock, and barrel. 20,000 barrels a day, 3 different oil fields, Jasmine, Nong Yao, and Menorah. These were making net about $15 million a month. And they bought it for $10.5 million.
Okay. So
which means, just for the record, that since all the economics from September 1st to March 22nd accrued to Valeura, that on March 22nd, Valeura gave Mubadala $10.5 million, and they received 15 times 7, they received $105 million.
So let's just pause there, right? Because I think this is the thing that breaks my mind when I watch this, right? Like the first, when people listen to it, they're going to say, oh my God, Mordechai's right. Like they signed a deal in December, retroactive economics to September, close it in March. They get paid 8 times what they're paying up front for it, right? So right off the bat, they're up, like their IR is infinite because they're getting paid for it, and they get an asset that's producing basically their purchase price and cash flow every month, right? So when I hear that, say again?
Much more than the purchase price. It's in cash or revenue per month.
Yeah, exactly. Per month. I said per month. Yeah.
Oh, yes. Yeah,
so
correct.
When I hear that, my first is, yes, Mordechai is right. This is the best acquisition I've ever heard of. I don't think there's anything that even compares. But then my second thing is, why is this not too good to be true? Like, if somebody sent me this email, I had a friend recently who sent me an email and he was like, hey, I know you're in finance. Somebody brought me this crypto hedge fund. Can you take a look at it? It's got some terms I don't understand. And they were promising 4% annualized per day. And I was like, look, I don't say this lightly and I wouldn't put an email, but that's a fraud, man. Come on, that's a Ponzi scheme. There's no chance. You just laid out, if somebody put this in email to me and told me the deal terms, I would say, hey, that's absolutely a Ponzi scheme, a fraud. There's no chance. So, like, why?
I wouldn't want to join the scheme. I wouldn't want to join this deal either for that fear. But, first of all, in this situation, the deal happened already. We're not talking about a future deal. This is in 2022. We're now in 2025. It's done. It happened. Here we are. That's one, obviously. But two, how did it happen? It's mind-blowing. So there's really two things that go together. One of them, the company kind of hinted at publicly. One of them they didn't really talk about, but speaking to management, they did explain to me the background. So first of all, Valeura Energy was looking to exit the Gulf of Thailand because they wanted to focus on clean energy. So they were getting rid of their oil assets for ESG reasons, which, coming from Abu Dhabi, the United Arab Emirates, that they're focusing on getting rid of oil for ESG reasons is I'm not sure what the world has come to. It's mind-boggling. But Mubadala Energy is one of the sovereign wealth funds, and they wanted to focus on natural gas and solar and I don't know what, but wanted to drop oil. Okay, fine. You say, okay, so they want to drop it, they want to sell it. Maybe they're even willing to give a good deal, but there's got to be other buyers out there. What in the world? Other people should be interested in such a deal. So the real answer is, although this deal was announced in December and the first deal was announced in April, this deal was actually negotiated earlier. It was the first deal to be negotiated. But it was only signed months and months later. What happened? What happened was that they were working on this deal in 2021, and they won the bidding process at a much higher initial price, much higher than 10.5 million. What then happened is that the sellers went silent. There was no contract. They had gone through an informal auction process, but nothing was signed yet, and the sellers went silent. And it appeared that the reasons why the sellers went silent is because the price of oil had gone up a lot to $100 a barrel, and they were having second thoughts about, it was a really profitable asset. They didn't really want to, maybe we should keep it. Yeah, it's making money. People like money. I also like money. I understand it. People like money. So they said they were having second thoughts. They went silent for months. And Valeura was thinking to themselves, okay, it looks like maybe this is not going to be a deal. Eventually, Mubadala resurfaced, and they said, yeah, they were having cold feet, they were dragging, but the higher-ups decided they have to exit, they must exit, but they really feel stupid about all this cash flow that's just been pouring in over these months. They don't want to give it away. So what they did was, instead of having signed the contract for the original, let's say, I don't know, I'm making up a number here, $150 million, yeah, and have it effective from the beginning of January of 2022, which would be the norm for when they were negotiating at the time. They said, you know what, we're going to keep the economics over the last months, and you'll get the economics for September. But that seems a little unfair to you, right? So therefore, what we'll do is we'll drop the price. We'll drop the price for the amount of money we made from January to September. We'll say, instead of 150 million and have it effective from January, they felt from their own way of looking at it that we'll make it 10.5 million and effective for September 1st. But this was already after the deal process was concluded.
But
they didn't reopen the deal process.
I understand everything you're saying, but that is a gift, right? I mean, they're gifting hundreds and hundreds of millions of dollars of value to this person. Because I
have no more background to share with you. I do not have any friends in Abu Dhabi. or on the board of Mubadala Energy, I really can't explain the process.
Because I've been involved, like I've had oil and gas companies in sales process before, and I know like oil and gas goes up $5. The hardest thing is oil and gas goes up $5 and everyone blows up the deal terms, right? The sellers want more. Oil and gas goes down $5, the buyers blow up the deal terms. Everyone wants more. What you had happen here was a 10-month pause, right? Where oil prices go up. The company says, hey, we don't want to sell. We want to keep all this money. And then eventually they come back and say, hey, let's just keep the exact same deal terms and lower the price. Like that cash gush we got, we'll just lower the price for you. Like it doesn't make sense. It's the biggest gift I've ever heard to anyone. And I mean, my first thought here when I saw this and heard this was, oh my God, this is the best thing, but I need to check who their auditors are. Like, and it's Deloitte, reputable auditors, but like, that's how incredible of a deal we're talking about here.
Cash. There's nothing being hidden there. You know, it's all you want to know how much oil is produced that's on Thailand government websites. They keep track of the oil being produced from the wells. All this is, you know, you can get monthly reports from Thailand. It's very easy to keep up with. You can get in advance of the quarterly reports. You can find out how much each of the fields are producing. You just have to, you know, some of the fields have 90% interest, 70% interest. You could just do the math yourself, and you know exactly how much oil that is being produced. The price of oil is public. There's really not that much that can be hidden here.
So I mean, I get.
Yeah, I agree with you. I call it the greatest acquisition of all time because I boggle to think that anybody could find a better acquisition. It doesn't really make sense. I don't understand Capital Energy. It was a strange process that got it to that deal, but even the original $150 million deal seems like, or whatever the number was, seems to, I don't know if it was $150 million. I don't know what the number originally was, but seems to have been a decent deal anyway, just for the assets as they are. These are assets that are producing at $100 a barrel, which was when it was being negotiated. It was producing 150 more million a year.
I guess the last thing, and again, it's just like, it's such a good deal. It's one of those things where it's like, it's such a good deal. If the deal economics were worse, I'd almost be like more understanding of it. One last question I have. Like, it does strike me, I know a lot of companies that did M&A in oil and gas M&A in 2022. And people can remember, you know, post Russia, Ukraine, oil's 100, nat gas is 9. I remember I was having a conversation with a nat gas CEO in June of 2022. And on that day, he was like, I just keep doing the math and nat gas is 9. I don't know how we're not going to 15. Like the demand is just outstripping supply too much. And that day is the day that big LNG facility in Louisiana had an explosion and took like 2 BCF per day or something offline. And that was that was like literally the absolute top. And I think about that story all the time. Anyway, reason I mentioned this is they do both of these deals, the greatest deals of all time. Not only are they so great, they're so great that in the oil and gas price environment of 2022, right? They're such good deals that they look good in hindsight today from 2025. And I would say these are like the only deals I know that are done in 2022 in the energy space where the buyer seems to have come out ahead. And not just come out ahead, like come out ahead kicking, like literally gone to the top of the mountain on them. So I guess just like, how could they structure deals so good that even with the energy environment that has developed over the past 3 years, they're just this far ahead?
No comment. I do laud the company's patience that they waited. They didn't take the first deal they saw and they waited until they found a good deal. And we'll talk later, but these two deals, which seem separate, are actually dovetail very well because the deal that they negotiated second but signed first, smaller one from bankruptcy, actually came with a load of $400 million of tax losses that when they bought the Mubadala Energy assets, and after spending a good year and a half on the paperwork and the technical and legal aspects to combine them, they're able to spread the $400 million of tax losses not over the measly Wassana field, which was small and wasn't really big enough to use all those tax losses. They're now able to spread it over most of the entire company, except one field, which means that first company that they bought for $14.5 million, not only did they get a producing oil field, they got tax losses that are worth $200 million once they combined it with the other company.
Is that unique to Thailand? Because like in the US, if you bought a company out of bankruptcy, you wouldn't inherit their tax assets. Is that unique to Thailand?
I don't know the legal aspects.
Yeah, it's just another thing. Like for $10 million, they buy a company and they, they're buying it for 1x cash flow, and they get 40 times their purchase price in tax assets. Let me ask a separate question. Okay, at this point, this is known, right? So it has been, you and I are talking here, it is approaching mid 2025. It's been 3 years since the first deal, 2.5 years since the second deal. You've got basically 2 years of full run rate financials. Like I'm staring at their 2024 audits, like 2023 basically have a full year, 2024 definitely have a full year. At this point, it is in the numbers, right? And the numbers are very good. I'm looking again, 300 million in cash flow from operations. We can talk about the invested capital and everything, but why has the market not picked up on this yet? Like, why is the opportunity here when, hey, these were incredible deals? Maybe you have doubts about them, maybe not, but it's in the numbers. They own the assets now. This is a 600 million market cap company with, Bloomberg says 160 million in cash. I think you said a little bit higher number, but we're talking about paying
160 as of the end of the year.
We're talking about paying less than 2x operating cash flow. Now there is real capex. We'll talk about that in a second, but we're talking about paying less than 2x operating cash flow for a management team that's proven they can create the greatest deals of all time. What is the market missing here?
So I think it's a combination of two things. The stock price definitely skyrocketed on the first deal. On the second deal, it skyrocketed in response to various good pieces of news that came out over time, and the stock is up tremendously. In general, most stocks that get a huge chunk of good news sometimes are not able to fully incorporate the greatness of the news simply because the people who look into it and are interested and buyers, kind of max out their capabilities. Most people are not willing to go 100% into one stock, however great the deal is. They're not willing to go 50%, 20%, they'll go to 5%. Some people are, adventurous. They're highly concentrated. They go to 10, 15%. And they'll max out. So you have that. I often find that very, very, very large bad news usually, is much easier to get fully incorporated, although even that not always happens. But very large good news can max out the people who are aware and interested. And then the second thing is it's still a relatively small company. It's traded on Canadian exchange. Thailand sounds weird. It's a 650 million market cap. There are plenty of institutional investors that not for them. It's oil industry. I'm not an oil expert. There's all sorts of reasons why it doesn't yet have. Listen, the last conference call on YouTube has, I think, last I heard was 29 views.
So
I don't think it has as much exposure. I mean, did you hear about it before I mentioned it to you?
No, I did not. Though
it has as much exposure as it deserves. And I think part of the reason is the story has yet to fully percolate through the industry, through all the people out there. That's part one. And part two, when people open up the financials, there are certain things that don't screen that well, which is you have this decommissioning liability that comes at the end, and it seems rapid. They're telling me that there's a reserve life index of 5 years, and then in 5 years, I can have this multi-hundred million liability to decommission. Yeah. And most people say that an oil and gas company needs to have a reserve life index of 10 years. That'll interest me. But when they bought it, it had a reserve life index of 2.5 years, together with a $200 and something million, 200 million around decommissioning liability. If you just did the math, you said, okay, they got a good deal. But at the present stock price, if I take their asset value, the oil in the ground, multiply it by how much I'll make from it, take out the decommissioning liability, I don't make any money. And I got that pushback from people I pushed this to. And this ties back into what I said earlier, that the Gulf of Thailand works very differently in its geology than many other oil basins, which is that officially reserve life index, 2.5 years, 3 years, 4 years, but it lasts for 30 years. You drill, and all the oil that you produce, you replace with the drilling having found more oil to replace that. As I said, reservoir, space, reservoir, space, reservoir, space, reservoir next to it, reservoir next to it. You move over 10 feet, well, not 10 feet, whatever, you know what I mean? Whatever it is, and you drill again, you got more.
So let me pause you there. I think I see actually where the variant view is. So at this point, it seems like the market has caught up and been like, hey, these are great businesses. And I will just use, let's say for 2024, 150 million in free cash after PP, and we can talk if that PP was too high or not. I think the difference that you are seeing versus the market is the market is seeing these are high decline wells and there's not a lot of life to them, right? So if I said, hey, these wells are all going to be gone within 5 years, and I'm trading this at 4 times free cash flow, and there's some decommissioning liabilities, that actually gets you to about the stock price, right? And what you are saying is, no, the wells are way, that life is way understated. There's a lot of undeveloped reserve, proved undeveloped reserves that aren't even on the books, whatever it is. I've got 25 years of life here, not 5 years. So I am buying, and basically the market is giving me that back half 20 years of life for free. And by the way, the decommissioning liability that the market is discounting that they're going to have to pay in 5 years at the end of the life of these wells, I can decommission. I can do it in 25 years. So I get 20 years of extra NPV on that, plus 20 years of extra free cash flow. And that's the difference between the two. Would you argue with that kind of being the alpha opportunity there? Plus, probably great deal makers here.
That is the alpha opportunity. I don't want to overstate the deal makers, by the way. I mean, they because part of it is a patience, but I don't think patience can get you this good deal. This good deal needed a confluence of luck. Yeah, I don't think
so I've been skeptical of the deals. You say that, but they did it twice. They did it twice, right? So once you've done it twice, you've kind of proven that you know how to hang around the hoop.
I will say this much: they're right now at about 25,000 barrels a day. Their aspirations are to reach 100,000 barrels a day, and they keep on talking that they want to do more inorganic acquisitions. But they also talk, and they seem to be serious, but they don't want to do any inorganic acquisition. They want to do on cash flow, accretive, maybe not as great as what they got, but a good deal. And I think their history has shown that they're willing to be patient. They have cash burning in their pocket for a few years before they sign the deal, and then they sign good deals. Since then, since the end of 2022, they've been talking about doing more deals, 2.5 years have passed. They haven't done another deal yet because they haven't gotten the right deal. So I think we can give, usually acquisitions is something I frown upon. The academics say that it's usually a bad idea. In my experience, like 90% of the time, the acquisitions, big acquisitions, are tendency for managers to increase the fiefdoms. They're not caring about shareholder value, and it's not worth it. It's really worth it. You all the time. It's just, again and again, they buy it. I don't know if I think just recent news. Family Dollar and bought
Dollar Tree bought Family Dollar for $9 and sold it for $1 billion.
This is the story all the time. It's crazy how often it happens. So I usually frown on acquisitions. Yeah, but I'm going to give them the benefit of the doubt here that their capital allocation has been stellar. Yeah, and they want to continue doing that. We'll see if they're able to come up. I'm not counting any inorganic acquisition in my analysis of how great stock is, but I think if there is an inorganic acquisition, that would be great. Organic growth, however, does have a lot to produce here because there's more exploration in areas where they can expand what they have now beyond just what it is already, which we could talk about as well. I just want to stress, I do believe that the big variance here is on the decommissioning liabilities and the reserve life index and the high well decline. That's definitely a major part of it. But I don't think there's really a variance of views if you really look into it. If you look into it, I think it's absolutely clear. There are many slides that the company shares which are really, really, really get to the heart of the matter. They really pound away on this. They show you for the whole Gulf of Thailand how the average reserve replacement, meaning how much reserves I find every year replacing the oil I produce. The average reserve life in the reserve replacement for the entire Gulf of Thailand, not their assets only, is 122%. Meaning you're replacing more than you produce. Then they show you, for these assets in particular, Jasmine, going back years, you can have, let me see, I have my notes here somewhere. Here. This is for Jasmine, one of their large, nice fields, somewhat later in life. It was started in 2005 with supposed reserves of 7 million barrels. Since then, it produced 95 million barrels. And ended 2024 with 17 million barrels of reserves. It started with 7. It produced 95 and the 17.
So I am looking.
That's not a reliable number. You cannot look at that and say, oh, there's only 17. It says 17. There's only 17. Don't expect there to be a drop more than 17. 17 is what it is. Here's non-Gao. Non-Gao is the most profitable. It has a apex of about $15 a barrel, gushing oil, very profitable. It started 2014 with 3 million reserves barrels. It's produced 29, and now at the end of 24, it has 16.9 million in reserves. Yeah, far more than what they started with. This is the story of all their fields, and then we could talk about under their administratorship when they've gotten it. They have here all the fields combined. The end of 2018, it's all their fields combined, the Jasmine, Nangao, Menorah, and Wassana all together. Ended 2018 with 20 million barrels of reserves, produced for 3 years. The end of 2022 was 21 million, same it started with. So you're not actually, using up your reserves when you produce. But I just want to speak out their own personal, when they run these fields, they put in a little bit more money into not just using it as a cash cow, but looking towards the future. And let me just find my notes to get the exact numbers here. In both 2023 and 2024, the reserve life replacement was not just replaced everything that it produced, it replaced more than twice what it produced. I have the number here somewhere. 1 second.
Let me ask 2 questions on this. Yeah. And for those of you who are interested in this idea, which I'd be surprised if you weren't at least somewhat interested in this idea after listening to this pitch, you can follow along with a lot of the math, a lot of the numbers Mordechai just gave out at their, I'm just flipping through, it's their March 2025 Capital Markets Day. Like this stuff he just laid out on the reserve replacement is all very nicely and neatly laid out on their asset by asset breakdown, which is like slides 43 or so of the thing. Let me ask you 2 questions here. So I understand they drill, and this field that it was supposed to have 7 million. Here we are 20 years later, and it's produced 95 million, and it's still got 16 million of life. That I mean, just like there's only so many dinosaurs that have died. That has to end at some point, right? So like, how can you feel part of the reason I am sure that they are having all this extra success is the technology has just gotten a lot better for extracting oil. And then I think they've also they do the field, and as you said, they do the well right next to it. But when does that end? At some point, there's just no more dinosaurs.
It will eventually end. There's no way for me to answer you. And the company will never say anything other than the reserves. They're not going to claim, they're not going to get up and say, we are going to tell you this is going to last to 2150. No one's going to tell you that. They're not going to tell you it's going to last to 2050. Officially, well, our reserves peter out in the 2033. Yeah. Or whatever it is. Yeah. But let's remember that when they bought the company, their fields were supposedly ending. They bought Menorah. Menorah was supposed to be decommissioned in 2025. More infill drilling, and no, we pushed it off to mid 2026. To mid 2026. Then, when they got control of Menorah, more drilling, more assessment, more appraisal. They pushed it off in 2023. They pushed off Menorah for 1.5 years. And then in 2024, with production, they pushed it off another 3 years. So now Menorah, which was supposedly being decommissioned, and in fact, they already had to give Thailand regulators $22 million of reserved cash, restricted cash, to cover the decommissioning, the imminent decommissioning of Menorah, which was imminent at the time that the cash had to be given to the Thailand regulators. Yeah, is now projected to last to mid-2030, Menorah. Now, can I prove to you that in 2025, the appraisal drilling will push Menorah out more? No, I can't prove it to you. But is that the way to bet? Yes.
Let me ask.
In all their fields, in 2024, the drilling pushed out every single field's end of life between 2.5 to 5 years. So now, what originally their latest field was supposed to end mid-2027, now their fields are going to the end of 2035.
Let me ask another question. So if I'm just looking at their slide.
Will it last to 2050? I don't know. If you ask me, I think in 2050 we'll be talking about, well, is it going to last another 2 years or another 5 years? And we'll have the same question then.
They have on their slides, and I'm looking slide 10 in their capital markets deck. They give their NAV of Canadian $13.60 per share. The stock, as you and I are talking, is $8.35 per share. So that's significant upside, right? More than 50%. I doubt anyone wouldn't take more than 50%.
Not counting all the upside from future. It's just counting the actual reserves on the books with the decommissioning liability at net present value, et cetera, taking out the OPEX and the CAPEX that's necessary to get the oil out of the ground. Taking all that into account is about $7.59 for the oil, minus all the liabilities, plus the cash on hand. That's where they get to that 1360 number.
I'm also just laughing. I hadn't seen this slide before. It's slide 11 of their investor deck. I guess it's their slide 10, but it's 11 in the PDF. It's their returns versus all of their peers since they kind of started the strategy. And they're up 1,400%. And the average peer would be probably flat. And the second best peer is 135. So they're 10x the second best peer. I'm just laughing at that. Let me ask you another question. So obviously you think there's a deep life here. I believe the way that the Thailand leases work here is that all of their concessions that they have with Thailand end in the early 2030s for most of their fields, and then they have a 10-year extension on top of that, right? So I do think there is a question of, hey, 2031 comes up and these leases are up, right? What happens? Is the extension just boom, you extend it 10 years, same terms, done? Or do you have to renegotiate some of the royalties, taxes, all that sort of stuff? And then B, I guess, is there a history when you get to 2040, all of the extensions are done? Obviously that's 15 years in the future. And I think the stock price and NAV is kind of only incorporating 5 years or so. But I am just curious, like what happens when when the extensions are done? Because you mentioned 2050 earlier and talking about how many years these have left. Like obviously they would need to re-win kind of the concessions.
That's a very great, insightful question. And I'm going to give a very non-insightful answer, which is about the first extension. I don't think there's ever been a situation where Thailand has not given a 10-year extension on a field that had oil to produce. They've always done that. Is it same terms? Yes. Is it absolutely simple, or do they need to give guarantees? They probably have to give some guarantees of the amount of money they'll put into working on it, and they'll have to give guarantees, maybe a small bonus sign up, but nothing major. They're not going to have to fork over the value of the field in cash to Thailand to get the extension. It's relatively simple. What happens at the end of the 10-year extension, where by law and regulation there isn't an official system of how to get another extension? The answer is I have no clue. So yeah, the fields, I don't know when they'll end. At that point, that's a little more tricky. Yeah, okay, but as you said, this is at all not being incorporated in the price. We don't need 2040 oil to explain, even 2040, certainly not 2050. We don't need that oil to explain the stock price now. Even just the oil as is now without any reserve replacement, we're 50% undervalued. And the fact is, with reserve replacement, and we could take these fields to 2040, this is not just 50% undervalued, it's like a third of what the expected net asset value, which, by the way, we're discounting at 10%. When we say it's worth $13.60, we mean that if you paid $13.60 for it, you'd be making 10% on your money over time. Right? It's discounted at a normal discount rate of 10%. It's not like this is what it's actually worth. Yeah, it's worth $13.60, and you'll make money on that. So if you're paying $8.35, it just writes itself.
Look, I think you hit on the Thailand risk. I think we've covered most of my questions here. We're also running up on the end of an hour. Anything else that you've spoken about this idea in a few different places? I know anything else people should be thinking about, or any other questions people ask that you think we should address here?
I'm just going to say two more points. One is that three more points actually. Now that I think about it, one is that when you mentioned this, really, I just want to underline it. Not only are you getting reserve replacement and pushing and getting more revenue, you're pushing off the end of life, which means that the liability of decommissioning is not looming large and soon. It's looming far off in the future, which at a discounted value is worth much less. In addition to that, they've been putting a lot of effort over the last 2 years with engineering studies on the decommissioning liability, and they've incorporated the latest technologies. A lot of decommissioning going on of well by well, and different new ways of doing decommissioning in the Gulf of Thailand, reusing parts and things like that. And they've been able to have these engineering studies that bring down the cost, the ultimate cost of decommissioning, besides the fact that you're discounting it at a greater rate because it's further off in the future, but simply bring down what the actual cost of decommissioning will be. Between the two, pushing off into the future and bringing down the ultimate cost, they brought down the decommissioning liability from the original about 200 million, more than 50%. Now it's about 90 million. That's on the books. It looks much better now when you only have an $84 million decommissioning liability instead of what they had before, $200 million decommissioning liability. It looks much better just on a screening basis. That's one. The second thing I want to point out is we've been talking about the capital allocation. They've been very good operators and very savvy operators, and very they've done a lot of they have this drill they have one drill that they're renting to use in their various fields, and they've used it in very clever ways. When Wassana was taken down, they managed to move around the schedule. They get more drilling done than the amount that they originally expected. So you're paying for the drill for the year. So if you're able to drill more wells, then your cost is the same, but you're getting more out of it. And they've been able to do appraisal wells that turned into development wells, get an appraisal and a development from the same well, and a lot of other things like that. You can read their capital markets. They have a lot of interesting tidbits of advancements they've made in the type of steel casing they use, and the type of how they do the well, and what type of technology they use. They didn't invent any of the technology, but they're using it well, and they're operating well. Their optimization around their ship fleet to share ships among the various fields. Their optimization on how they save money on gas by idling engines in certain ways that a little bit non-standard but saves money. They installing, as we speak, a BTU generator at Jasmine to use the waste gas as fuel instead of having to pay for fuel, so that supposedly environmentally friendly, I guess, instead of wasting the gas, but also saving money on OpEx. So they've been doing things. They bought there's more CapEx, but they bought the non-gal floating storage facility for $19 million, and that has a 2-year payback, so they're saving money on OpEx that way. They are operating in a very efficient and useful manner for the shareholders. That's the second point I wanted to make. And the third point I want to make is we've been spoke the whole time about how undervalued it is just what there is, even without reserve replacement, and much more so with reserve replacement. That's just what you see, what you get. Then there's maybe they'll do another great acquisition. Okay, no way to know about that. But I want to talk, there's more organic growth here as well. They are spending minimal money, $8 million in 2024 on exploration. They're expecting $11 million on exploration in 2025. I just look at some of the CapEx is sustaining, some of the CapEx is the CapEx for the year is about 135 million expected, plus another 11 million for exploration. Maybe about 100 million of that is sustaining CapEx. The rest is growth. I just look at all of it as, we'll call it sustaining, and it's still a great deal. I don't have to piece out what's sustaining, what's growth. We'll just call it an expense, and you're still coming out nicely ahead. At $75 a barrel, they're still making 150 million a year, even if you look all that as sunk cost, not getting any growth. Yeah, just replacement value. But there is definitely a few areas of organic growth, including an upcoming catalyst that people might want to keep an eye on. So they have a rat tree exploration in Jasmine that's going to be dug sometime this year, I believe in Q3. I don't remember exactly. They have it on the slides exactly when they're digging that well. That's pretty exploratory, but that could really bring up a whole new area of the field. They had non-gal D. Non-gal C was started last year and has been gushing oil, and they have a few appraisal wells that have already done non-gal D that have come up positive, and They're doing more this year, and we could probably expect a whole new non-Gaudi, which is not on the reserves at all, and it's not part of the replacement, just a new area of the field that's unrelated to them, next to and can share facilities, and you link it via pipeline. But it's really a new section of the field that's up and coming. And then what's really the next catalyst is the Wassana field. The Wassana field now is making about 4,000 barrels a day from a small platform that's a small mobile platform that's reaching end of life and has to be replaced. Right now, the official reserves report assumes that they're going to replace the mobile platform with another mobile platform, and that's the cost that they're taking into account when they come out with their net asset value of 1360 a share Canadian. But what they're actually looking at doing is this mobile platform is relatively small, can't reach as, if they replace it with the same mobile platform, can't reach as much oil as is available throughout the Wassana field. And then there's Wassana North and Wassana South, both of which have appraisal wells and exploratory wells that have covered up, have section of the field. So what they're thinking of doing, and really looks like they probably are going to do, but the final investment decision is coming in the beginning of Q2. So within a very short amount of time, a few months, we should find out what's happening on that. The final investment decision is considering to make a new, more, not a mobile platform, but a more real platform, move it over to be more in the center of the field and have a larger catchment area. And then later on in time, you'd be able to build, like they did with non-Gauss-C and maybe non-Gaudi, build smaller platforms to the north and to the south that connect. That would be Wassana, just the final investment decision that we're talking about on building a bigger platform would add to their reserves about 12 million barrels of oil. And then we still have Wassana North and Wassana South, which we're not counting yet because we haven't made a decision about expanding. But that expansion is very real, very likely to happen. It would cost about $150 million to develop that platform, for which you'd get 12 million barrels of oil, plus all of the reserve replacement that comes with that, plus the Wassana North later on in time, and the Wassana South later on in time that comes with that, with more CapEx. That would probably come online sometime in 2027. They're saying 2 years from when they start, so Q2 2027 is when they would get first oil from the larger new platform instead of what they're doing now. They haven't yet officially made a decision on that. They said the decision is coming in a few months. When that comes out, they're going to have a new a reserve report to match, a new CapEx guidance to match, et cetera, et cetera. But that's very likely to be add much more to the story here. And I just want to underline, they actually speak, whenever they speak about acquisitions, they say they like acquiring fields that have the opportunity to sink CapEx in at profitable rates. And that's exactly what they got here. They got a small field that has the ability to make into a large field, that's in the ability to make into a mega field. And that's what they're looking for, and that's what they got. And again, the decision hasn't been made, but they've been highlighting this again and again, and it does look most likely, just running the numbers on paper, it should make sense, as long as it's not a blowout number for how much it costs to develop it, and the number is somewhere in the range of where it makes sense, where it should be, then it definitely seems to make sense to go ahead with that development and add hundreds of millions of dollars of value to the company.
Well, we're running quite long at this point, so I think we're going to have to wrap it there. I mean, it's just a fascinating study, and as you called it, I mean, I didn't believe it when I saw the slides. I can't think of another acquisition. People say, "Oh, Google buying YouTube or Facebook buying Instagram." Yeah, those were multi-bagger home runs. But like here, you had a multi-bagger from day one, right? They gave you 8 extra purchase price on day one, and then you had these cash flow gushing assets. Like it's just like nothing I've ever seen before. So Mordechai, this has been great. Again, Mordechai's website mentioned at the open. I'll include a link in the show notes. Go there, find a little bit more about everything Mordechai does, and maybe finding deals and stocks not quite as good as the one that these guys pulled off, but hopefully 98% of the way there. Mordechai Yavneh, thank you so much for coming on for the 3rd time, and looking forward to the 4th time.
Okay, great. Thank you for having me. Again, if you like money, you like Valeura, And if you enjoyed hearing about Valeura, then check out my website. Reach out to me. I'd love to talk about Valeura or any other analysis, research that you'd like or whatever. My shingle's open for outside consulting, analysis, research, what have you.
Perfect. Talk to you, man.
Andrew.
Today's episode is brought to you by AlphaSense, the market intelligence platform I rely on for faster, deeper insight. If you've used platforms like Tedious, you'll feel right at home. But AlphaSense takes it further. With over 150,000 expert call transcripts and 450 million plus premium documents, it's become my go-to resource for qualitative and competitive research. And now, with generative AI tools like GenSearch and GenGrid, AlphaSense makes it easier than ever to accelerate your workflow. GenSearch lets you ask natural language questions, like what's driving margin pressure in semis, and instantly surfaces answers pulled from expert calls, earnings transcripts, filings, and more. GenGrid takes it a step further, automating repeatable workflows by applying multiple prompts across dozens of documents at once. It delivers clean, table format answers like sales trends, macro commentary, or pricing signals, all with clickable citations so you can trace insights directly to the source. Whether you're digging into a company, comparing peers, or parsing 10Ks at scale, AlphaSense gives you a speed and depth advantage. Try it for free today at alphasense.com/YAVP and experience the future of research. That's alphasense.com/YAVP. A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.